Hey everyone, this is Kirk here again at Option Alpha, and I wanted to get this video out tonight to talk about the Fed's new Operation Twist program that they unveiled today. So I put together this quick presentation for you, just a couple slides, but it goes over the key points that I think everyone needs to know about what Operation Twist is. And so it's the Fed's last ditch attempt, I guess, before another round of QE3 to get this economy going. So we'll get right into it. You'll have everything you need to know about what Operation Twist is at the end of it. So Operation Twist, what is it, right? The program is specifically designed to lower yields on long-term bonds, right? So the Fed's already done this on short-term rates by buying up mortgage bonds and by pumping money into the system by buying up government bonds. So they've done this on shorter-term rates already, but now they're going to try to do it on long-term securities as well. And so the same thing goes. They're going to change this by purchasing long-term securities. Why do we need it? Well, over the last 2 years of quantitative easing, the Fed has acquired a considerable amount of federal bonds. In other words, loans to itself, to the US government. So the Fed has gone out there and deliberately printed money and bought bonds that it now has loans out to the US government. So most of these loans are going to mature in 1 or 2 years. So again, they're mostly shorter term securities. And so once they mature, the Fed has to do something with that money. So what they're going to do is they're going to take that money and purchase longer term securities. So 10-year, 15, possibly even some of the mortgage-backed securities in the 30-year realm in an attempt to lower the long-term rates as well. So again, what's the goal here with this program, this Operation Twist? And the goal is to lower or flatten the yield curve. So the yield curve goes from all of the short-term securities here, which are basically at zero right now, to some of the longer-term securities at 30-year terms. So you can see this is 30-year term. And I took this chart right off of Bloomberg today. So you can see it's already starting to work even today. It started to flatten the yield curve a little bit. Yesterday's previous close was this orange line, and today after the announcement, the yield curve already started to become a little bit more flat. But that's the whole goal, is some of these longer term securities, these 10 and these 30-year securities, are going to be bought up by the Fed with more Fed dollars, and so they're going to push these yields down, or these interest rates down. That's going to flatten this yield curve across the board. So if we look back, or if we take a look at specifically what happens again, just to get a complete understanding of this, if the Fed trades in some of its shorter term bonds for more of the longer term bonds, then it takes some of those proceeds and buys longer term securities. So as the demand for longer term securities goes up, then that drives down the yield, or the effective rate of return on the investment. So the yield is actually what determines interest rates in the market. So what the Fed is trying to do with this Operation Twist here is take money from shorter term securities, buy long term securities, and push interest rates down for things like car loans, bank loans, mortgage rates, etc. So right, already short-term lending rates are already at really, really low levels, but they also want to do that on the far end, or on the long-term end as well, and that's the way they're going to try to do this with Operation Twist. So here's the big question, right? What happened in the 60s? Is this thing going to be successful or not? Well, the last time the Fed tried this was in 1961, and the policy and the program actually came out in 60, and it only managed to lower long-term rates by 15 basis points. So again, it didn't have a dramatic impact. And my personal belief, and my answer, I guess, to the question is it going to be successful, is that we probably won't see a dramatic impact on or improvement in the economy, because rates are already at historic lows. Now, this would be completely different if rates were at 8, 9, 10%, but they're not. They're at 0, 1, 2, and 3. So people aren't going out there and taking advantage of these rates. You can already see that with home values and the mortgage and the real estate market. Mortgages are already at historic lows, but when people don't have any jobs to qualify for a new rate or refinance, or if they're upside down on their property, they can't take advantage of it. They physically can't take advantage of it. And I think that's the same thing. Lowering rates right now while it seems great, is going to have minimal impact because everyone should have already taken advantage of it by now. And if they haven't, 15 basis points, 20 basis points in yield is not going to, account to much in the long run here. So my personal belief is that this won't amount to a lot of impact, but of course, it's a try. We don't know for sure. I don't know for sure. Who knows? It's definitely something worth going after, I guess, and that's the way the Fed feels about it. So, hopefully, this was helpful for you guys. Thank you as always for watching, and I hope you guys enjoy these videos and these tutorials. As always, if you have any questions or comments, please leave them right here on the blog or on YouTube. And happy trading.